Cromwell Property Group has recently put out its full year 2012 financial results. The company has also provided a market update giving its thoughts on where it sees the current state of the property market. Paul Weightman is the Chief Executive Officer of Cromwell and he joins me in the studio to run through the latest details from Cromwell. Paul, thanks for coming in. What is the Cromwell market view?
The market view basically summarises our view of the main sectors, both in terms of industry sector and geographic sector in Australia. It's for the benefit of our investors and summarises in large part our views on the investment landscape and the property market in Australia.
And Paul, Cromwell's portfolio is really exposed to the office market. Can I get you to run through what you're seeing in that space at the moment?
The office sector represents about 90% of our invested assets at the moment. We're invested heavily in office because we think it offers the best returns, both in terms of immediate yield and in terms of total return over the next 3 to 5 year period. We take that view because we think that in terms of supply, the office market is either currently in equilibrium or slightly undersupplied in most markets, and because of various structural issues with the retail and industrial sectors. In terms of opportunity in the office markets, we see with recent developments in the commodity sector that the Perth market is likely to come under some pressure. Brisbane, although it has been supported by the commodities sector generally, is likely to show more strength because of its exposure to the oil and gas sector rather than iron ore and coal. The Sydney market is generally underwritten by the financial services sector, and we see continuing weakness in the Sydney market for at least the next 2 to 3 years until there's some sort of recovery in the global economy. Melbourne's shown good strength over the 2 year period up until about March this year. We've seen something of a fall off in tenant demand in Melbourne, and at present you could probably say there is some weakness in the Melbourne market. Whilst there's new supply coming through, however, we think the Melbourne market is fundamentally sound and will continue to show good levels of absorption. So in terms of rating the markets generally, Brisbane we see is probably the strongest performing market, Melbourne second, Sydney third.
And Paul, you're doing a roadshow speaking with investors following on from the full year results presentation. What's the feedback from the market on the results and what message are you passing back to investors?
Look, generally the main questions for Cromwell relate to the security of our distributions going forward, the fact that we have a very simple balance sheet, and I think people are always looking at the wider REIT sector of the moment, looking for simplicity, and when they find it, they're a little bit surprised because, let's face it, over the last 20 years, REITs have become very complicated creatures. A lot of them have active businesses, a lot of them have development arms. So for our investors, the focus is on making sure that what you see is what you get. And with Cromwell, with our long-weighted average lease expiry profile, with the covenants that we've got, with the exposure to the office sector, generally the answers that we're able to give reassure people that it is a yield play for investors that has a very secure long-term cash flow.
And Paul, just a final point. In terms of opportunity in the property market, do you still feel that there's opportunity for businesses like Cromwell to look at acquisitions?
I think there's always opportunities. What we've seen over the last 4 or 5 years is a continuing widening of the valuation gap between prime property, secondary property and development property. We see significant demand for core assets, Sydney CBD office assets, regional shopping centres. That's where all the cash flow from the major funds and the offshore investors is directed. A lot of the secondary assets are orphans. In turn, because of the fact that their values have fallen and they're demonstrating more attractive price parameters at the moment, they present opportunities for the astute investor or for the manager who can actively manage an asset and deliver some upside. So I think risk is something that's priced by people when they identify an asset. If you can mitigate risk through active management and you can manage the outcomes, there's a lot of money to be made in this market and over the next 5 years.
Well, Paul, thank you very much for coming in. It's great to catch up and we appreciate you taking the time to talk us through some of the developments at Cromwell.
Thank you.